Subscribe to my channel Report Stock.
Welcome to the Deep Dive. Today we're really getting into the weeds with SUNE Energy, Inc. They're a pretty significant player in solar and backup power. We've got their Q2 2025 financial report here, the official announcement, and our mission is basically to cut through the noise, find the key insights, maybe some surprising bits, and figure out the real story behind all these numbers.
Exactly. And it's more than just one company's financials, isn't it? When you look at a report like this, you're kind of taking the pulse of that whole segment within renewables. It really shows you how things like, well, major policy changes can hit a business directly, sometimes quite profoundly.
Okay, yeah, good point. So let's unpack some of the headline numbers first, the things that jump right out from this Q2 report. First off, their gross margin expanded up to 37%, which sounds pretty healthy.
That's quite strong for this sector, yeah.
And then total debt. It declined by $11.7 million. That's like a 61% improvement just since the end of last year, December 2024. Huge drop.
Really significant deleveraging. Shows financial discipline.
And looking forward, their residential backlog grew quite a bit. It was $27.1 million at the end of June. And then just a month later, end of July, it climbed again to $35.6 million.
And those are really important metrics. That margin suggests they're operating more efficiently, getting more from each sale. The debt reduction, well, that speaks for itself. Healthier balance sheet, less risk. But that backlog growth, that's your pipeline for future revenue, right? It signals strong demand, definitely. And maybe, just maybe, it hints at external factors pushing consumers to act now. Could mean a big revenue jump is coming.
Right, that makes sense. That shift in consumer behavior you mentioned. So what are the strategic moves driving this? We should probably talk about the leadership. Scott Maskin, the CEO, and James Brennan, the CFO, they came in during 2024. And the report says they've been focused on, strengthening operations, cutting costs, slashing debt, boosting efficiency. Standard stuff, but clearly working. But here's where it gets maybe really interesting. The report mentions this One Big Beautiful Bill Act, OBBA, passed in July. It calls it a major policy reversal. What's the deal with that?
OBBA. Yeah, that's a big one. It's a perfect example of how policy can just, boom, reshape the market almost overnight, the immediate effect. A pretty considerable jump in demand for residential solar, especially in New York and Hawaii.
Why those two specifically?
Well, it's no coincidence they're two of the most expensive places for electricity in the whole country. High baseline costs make solar more attractive anyway. But this surge now is also driven by urgency. People trying to get systems installed before the Section 25D federal tax credit deadline. That's December 31st, 2025.
The tax credit deadline.
Right. Yeah, it's a significant federal incentive. Put a deadline on something valuable and, well, you create a rush. People don't want to miss out. So SU Nation's response seems pretty strategic. They're anticipating finishing a lot of this new residential work by the end of this year. At the same time, their commercial side is picking up too, with projects booked into 2026. So they're not just relying on the residential rush. And what's really smart, I think, is how they're diversifying, looking at new revenue streams, potential acquisitions, partnerships, and specifically pivoting towards leasing and third-party owned systems, especially in places like New York and Hawaii. The thinking there is that demand will likely stick around even after the tax credit changes, just because of the utility structures and those high electricity costs. It avoids that potential boom-bust cycle.
Gotcha. So capitalize now, but build for later.
Yeah.
Makes sense. And stepping back, the long-term case for solar is still really strong, isn't it? Policy shifts aside, the value, the environmental side, energy independence, it's all still there.
Absolutely. Fundamentally, the trend is clear.
Okay, let's dive a bit deeper then into the actual Q2 2025 financials compared to Q2 last year, 2024. Total sales were $13.1 million this Q2. That's actually down a tiny bit from $13.5 million last year. Report says it was higher sales in New York, but offset by declines in Hawaii, at HEC, and in service revenue.
This slight dip, yeah.
But their consolidated gross profit margin improved, like we said, 37% of sales, up from 35.4%, even though the actual dollar amount was about the same, $4.8 million.
So better profitability per sale, even on slightly lower revenue. That points to efficiency gains.
And their SG&A expenses, selling, general, and admin, they also improved, down to $6.4 million from $6.6 million. Cost optimization paying off.
Right, tighter ship.
But, okay, here's the bit that might make you pause. The net loss, It actually increased. It was $9.6 million this Q2 compared to $6.9 million in Q2 2024. What's going on there?
Yeah, that's where you need to read the footnotes, so to speak. It's crucial context. That Q2 2025 net loss number includes a very large non-cash charge of $7.5 million.
Non-cash, meaning?
Meaning it's not actual cash going out the door. It relates to the fair value remeasurement of something called warrant liability. Think of it like an accounting adjustment for financial instruments, options basically, that could potentially turn into stock later. It reflects a change in their potential value on paper.
Okay, so it's an accounting thing more than an operational cash drain.
Precisely. And to compare, in Q2 2024, that specific charge was much smaller, $3.3 million. Plus, there were some financing fees back then, too. So what's fascinating, right, is how different metrics tell different stories. If you look at adjusted EBITDA,
Which strips out things like interest, taxes, depreciation, amortization, and these non-cash charges.
exactly, their adjusted EBITDA loss actually improved. It narrowed to $1 million this Q2 from $1.7 million last year. So operationally, once you filter out those accounting adjustments, things look better. It shows you need to look beyond just that bottom line net loss number.
That makes a lot more sense. So the underlying operations are healthier, despite the bigger net loss figure. Okay, so what does this all mean for their overall financial stability? Let's look at the balance sheet. June 30th this year versus the end of last year, cash and cash equivalents, way up. $3.2 million now compared to just $8 million. Almost a four-fold increase.
Significant improvement in liquidity. Good sign.
Total debt, as we mentioned, that dramatic 61% drop, down to $7.5 million from $19.1 million.
De-risking the balance sheet. Very positive.
Accounts payable and inventories also showed improvement. Better working capital management, it seemed.
Efficient use of resources.
And current liabilities overall improved significantly, down to $12.8 million from $27.2 million. And maybe the biggest one, stockholders' equity jumped to $22.1 million from $8.5 million. That's a substantial strengthening.
It really is a significant cleanup, as you put it. And a key part of this, if we connect the dots, was something they did during Q2. They strategically terminated all their outstanding Series A common stock purchase warrants.
Okay, what does terminating warrants mean practically?
Well, these warrants gave holders the right to buy company stock at a set price later. By getting rid of them, SU Nation eliminated the potential for up to 652,174 new shares being issued if those warrants were exercised. It prevents future dilution for existing shareholders, simplifies their capital structure. The report calls it delivering meaningful value to shareholders. It shows they're using their improved cash position strategically to clean things up and boost confidence. It's a deliberate move towards better financial health.
Right. Tidying up the structure for the future. Okay, so looking ahead then, they reiterated their full-year guidance for 2025. They expect total sales to land somewhere between $65 million and $70 million, which, if you compare it to 2024's $56.9 million, that's a projected increase of, 14% to 23%? Pretty solid growth.
Decent top-line growth expectation, yeah.
And maybe more importantly, adjusted EBITDA. They expect that to turn positive, somewhere between $0.5 million and $0.7 million for the full year. That's a big turnaround from the loss they posted in 2024.
It is. But, it's important to remember the usual caveat with guidance like this. These are forward-looking statements. They're based on what the company sees right now, their current estimates, but they don't account for things outside their control.
Like what?
Oh, potential new tariffs on solar components, unexpected global supply chain issues, shifts in the wider economy or industry dynamics, or, crucially, more legislative changes. Any of those could definitely shift the actual results. It's just the nature of this industry, very sensitive to external factors.
Understood. Standard disclaimer, but an important one here. So, wrapping things up then, key takeaways seem to be SU Nation is navigating these big policy shifts pretty strategically. They're showing real improvements in operational efficiency, that higher gross margin, for instance. And maybe most critically, they've significantly strengthened their financial foundation, cutting debt drastically, cleaning up the capital structure. Seems like they're positioning themselves well.
I'd agree. They seem to be managing the current policy-driven surge while also trying to build a more resilient business for the longer term. And maybe, just as a final thought for you to chew on, think about that Section 25D tax credit deadline again, December 31st, 2025. We're seeing this surge in demand now. How do you think that deadline effect might influence SU Nation's sales and backlog performance in the first half of 2026? And what could that mean for the wider residential solar market after that big incentive change is something to watch.
Subscribe to my channel Report Stock.